Hi, welcome to Arkintel. All the warning signs are flashing red, but nobody wants to say it. America's economy isn't breaking with a bang. It's slipping, almost silently, towards danger. The bond market is flashing distress. Job growth has slowed to a crawl. Housing is collapsing, and inflation refuses to disappear. For now, headlines still talk of resilience. Markets still trade on optimism. Politicians still promise stability. But beneath the surface, the data tells a darker story, one of cracks spreading through the foundation. This isn't the kind of crisis that announces itself overnight. It's the kind that builds slowly, quietly, until one day it's undeniable. The real question isn't if a recession is coming. It's whether it's already begun and we just don't see it yet. The first alarm comes from the bond market, the yield curve. The difference between short-term and long-term treasury rates has been one of the most reliable predictors of US recessions. Today, the spread between the 10-year and the 3-month treasury is almost flat, just 0.04%. Historically, whenever the curve inverted or flattened like this, a downturn followed within 12 to 18 months. Investors are signaling that the short term looks risky and the long term isn't inspiring confidence either. Then there's the labor market. For much of the past 3 years, jobs were the strongest pillar of the US economy. But August changed the tone. Unemployment rose to 4.3%, the highest in nearly 4 years. Only 22,000 jobs were created nationwide, a stunning slowdown compared to the monthly averages of over 250,000 seen in 2022 and 2023. Nearly 2 million Americans are now classified as long-term unemployed, meaning they've been out of work for more than 6 months. These workers make up more than a quarter of all unemployed. This isn't a collapse yet, but the labor market has lost its momentum. Housing is showing the sharpest decline. In August, housing fell 8.5% month over month, dropping to an annualized pace of 1.307 million units. Single family fell by about 7%, and new permits for future construction dropped to 2.2%. These numbers tell us builders are pulling back, not just because of today's weak demand, but because they expect tougher conditions ahead. When construction slows, it doesn't just affect builders. It ripples through the economy. Fewer jobs in construction, lower demand for materials like steel and lumber, and less household spending on related goods. GDP growth complicates the picture. On paper, the second quarter of 2025 looked strong, with an annualized growth rate of 3.3%. But that came right after a 0.5% contraction in the first quarter. The rebound looks less impressive when you zoom out. Projections for the full year have been cut sharply. Economists now expect growth of only 1.4 to 1.6% in 2025. That's well below the post-war US average and signals an economy running out of steam. Inflation is another sticking point. The most recent readings put inflation around 2.9%, depending on which index you use. That's down from the peaks of 2022, but still above the Federal Reserve's 2% target. It's high enough to squeeze households, but not high enough to give the Fed a clear excuse to hold rates steady. This is the most dangerous zone. Prices aren't stable, growth is fading, and the central bank has little margin for error. The debate among economists is fierce. Some models already suggest that the US slipped into a mild recession earlier this year. One advanced statistical approach, which tracks unemployment and job vacancies, placed the probability at more than 70% that the economy was already in recession as of May 2025. The logic is simple. Rising unemployment, slowing housing, and a near flat yield curve are all classic recession signals. But others push back. They argue that the strong rebound in GDP during the second quarter proves the economy still has life left. Consumer spending hasn't collapsed, and job growth, while weak, hasn't turned negative. From this perspective, America is just slowing, not shrinking. The truth is that economic data always lags reality. By the time a recession is officially declared, it's usually already been happening for months. That's why this moment feels so precarious. We may already be in the early stages of a downturn. Only time will confirm it. What are policymakers doing to stop this slide? The Federal Reserve has taken the first step. In September, it cut its benchmark interest rate by 25 basis points, lowering it to the 4 to 4.25% range. That was the Fed's first cut since December 2024. Officials have indicated that 2, possibly 3, more cuts could come before the end of the year, but everything depends on incoming data. If unemployment rises further and inflation keeps easing, deeper cuts are on the table. But if inflation proves sticky, the Fed may hesitate. Monetary policy alone won't be enough. That's where fiscal stimulus comes in. Congress has the power to deploy targeted relief, expanded unemployment benefits, tax breaks for working households, and incentives for home builders to stabilize the housing market. Large-scale infrastructure investment could also boost jobs now while supporting long-term growth in energy, transport, and artificial intelligence technology. But stimulus is only one piece of the puzzle. Structural reforms are also needed. Trade tensions and tariffs have raised costs for businesses and consumers. Energy prices remain volatile. Supply chains are still fragile. Addressing these pressures would help bring inflation down more quickly, giving the Fed more room to cut prices without risking a resurgence of price spikes, and providing stronger safety nets, from retraining programs to support for displaced workers, would reduce the human cost of any downturn. The risk isn't just a short, shallow recession. The real danger is that the slowdown drags on, sapping confidence and leaving households and businesses cautious for years. Rising unemployment could erode spending power. A weak housing market could pull entire industries down with it. And if inflation refuses to fully recede, the Fed may be forced to choose between stabilizing prices and protecting jobs. At the same time, the US still has advantages. Consumers are still spending, even if more cautiously. The dollar remains strong on global markets, giving the US financial leverage. And American innovation in technology like AI and energy continues to attract investment. If policymakers act decisively, this slowdown could be limited to a stumble rather than a collapse. So, is America sleepwalking into a recession? The signs are clear. A yield curve on the brink, unemployment rising, housing in free fall, and growth forecasts fading. The lights are flashing red, but the alarms haven't gone off yet. Recessions aren't just numbers. They're about confidence, psychology, and timing. If the Fed cuts fast, if Congress acts, and if inflation keeps cooling, the US could dodge the worst. But hesitation, gridlock, or a global shock could turn a slowdown into something far more painful. The next few months will reveal whether this is turbulence or the first chapter of a deeper downturn. One thing is certain, ignoring the warnings is the most dangerous move of all. If you found this video insightful, make sure to check out Is Italy the Next Dead Time Bomb for Europe? In this video, we break down Italy's $3 trillion debt crisis, why rising interest costs, Eurozone constraints, and banking risks are pushing Europe's third largest economy toward a breaking point, with consequences that could shake the entire Eurozone. Click the video to watch now.